We might make a start. I think there's over 40 or 50 people online, so we might get going. Rob Milner's my name. We're doing this a little bit differently this year. Brickworks are going to present first, and then at 1 o'clock, Soul Pattinson will do their presentation. Welcome everybody. Nice to see everybody back again. I'd just like to introduce, most of you all know Lindsay. On his left is Grant Douglas, our new CFO, so welcome Grant. And we have some senior staff here from Brickworks as well. As you've seen this morning, an excellent result from Brickworks. Obviously the highlight was the property performance and the increased dividend that they received from Soul Pattinson. It's been interesting this morning talking to a few of the press and trying to get your head around what's going to happen in the future, where we're going, inflation, interest rates, etc. And it was quite alarming yesterday at the Brickworks board meeting, and Lindsay said that their cost of pallets at masonry had gone up 400,000. So when I saw him this morning, he said last month we were paying $20 to $22 a pallet. This last month we paid $50 a pallet. So that's going to give you an idea of what I think is facing us all with increased costs. And that was, I think, Lindsay, would you say $400,000 just straight off the bloody bottom line for one part of the business? I think we've all got to be wary going forward where all this is going to end up. So enough doom and gloom for me. I'll hand over to Lindsay.
Good afternoon, everybody. Great to see you all. It's great to have a lot of people in the room today, as well as those people that are online, and we look forward to next year having everybody here in the room. So that's what I'll go through here. Give a bit of an overview, the divisional reviews. Grant will handle the financials, and then we'll talk outlook, and then we'll go to questions. So I never thought in 1999 when I took over this job that I'd get the opportunity to stand up here and tell the analysts, our investment community, that we just did more than $1 billion in sales. But I'd never ever thought that we'd also be saying that we did over $1 billion in EBITDA. So unbelievable result that came together this year, and I thank all the people for all the effort, because it wasn't exactly all straightforward. There was a few little problems along the way, but I won't dwell on those. So we're just looking at the main things there. That the underlying profit was a record at just shy of $750 million, up 159% on last year. All four divisions improved their results, which is a really incredible effort, and we achieved a number of very strategic objectives during the period of time. Property, once again, was an incredible standout, and I think this just shows that we've been in the right sector as far as industrial property, particularly under the current environment of the last few years. We launched the Brickworks Manufacturing Trust with 15 of our properties. We delivered strong growth in North America after struggling under all the difficulties of the last few years, and we've got a significant scale over there now where, believe it or not, on actually dollars turnover, we're equal second biggest brickmaker now in the US. And we also were able to, because of the increased asset base and the income that came from the manufacturing trust, we're able to reduce our gearing to just 15%. So I think we're in a very strong position, no matter what is thrown at us over the next year or two. So just go through those main numbers. $1 billion, that's getting used to that from the past. $1.093 billion in income, $1.058 billion in EBITDA, $746 million in underlying profit, $854 million in statutory profit, underlying earnings of $4.92 a share, and the final dividend was up 3% to 41 cents, bringing the total dividend to the year to 63 cents. Looking at that dividend, we're starting to, I think, build up a pretty impressive track record there. It is some 46 years where it has either increased, been steady, but never gone backwards in 46 years. And there are very few companies that are able to claim that. And it's a compound increase of over 20 years of 7.1%. So very proud of that, and I'm confident at this point that going forward we're going to be able to continue that strategy as we have in the past. Looking at the growth of Brickworks over a period of time, 12% compound over 54 years. And the reason we say 54 years, it was the 1968 that the relationship with Washington H. Soul Pattinson was set up. So that's an excellent result. So $1,000 invested then would be $566,000 today. Just looking at our asset backing, and we don't seem to get enough credit for this, our share of the Soul's investment is $2.4 billion. The property trust now, combining the two, is actually $1.75 billion. The building products has net tangible assets of $585 million, including 4 parcels of land that I'll talk about their valuation later on, but they're best part of $0.8 billion of land in there, so I think the valuation based on that metric isn't quite right. So that gives us a total of over $5 billion, less our debt, $33 a share. So as of yesterday, I ranked the shares at being 34% undervalued. Looking at our safety, we don't want to make any money by hurting anyone. It's the number one priority in all of our operations, that we don't do anything without finding a safe way to do it. We've continued to improve, and it's really great to see the progress that we've made in the US, which has come down quite dramatically to 11.7, a TRIFR of 11.7 versus 14.3 last year. And in Australia, 11.1 in that same period. And if you've got to look back, if I look back 20 years, we used to have lost time injury a week, and we had one last year, and that was it. So in Australia, so it's a really incredible improvement of that period of time. Looking at sustainability, it's something that all of our investors focus more and more, and as recently as this morning I got another letter from another major shareholder just focusing my mind as if it already wasn't. But I think we've got some very good credentials in this area. There's very few companies that guarantee their products for 100 years, and that's what we do. Most of our bricks are made from a shale, which is very abundant in the world, and here in Sydney a very large percentage of that is actually recycled material that comes out of excavations. And of course, at the end of that 100-year life, I think the bricks we're making today will last well beyond 100 years. The bricks can be recycled or reused. We are working towards, reaching the government's goal of 43%, I think it is, by 2030 emissions. But in actual fact, since 2006, we've already reduced our emissions 42%. So effectively, we've already achieved the federal government's goal with a few years to go. But we'll keep working on it, because it's not as easy as you think, particularly when you're talking about replacing kilns, etc., or building new systems to produce energy. They don't happen overnight, they take time. We have a number of plants already. We've got 2 running on landfill gas. We've got 1 running on sawdust. We've got a collaboration agreement with DeLorean, where we're working on making biogas, and we hope to make a decision in the next 12 months where we go ahead with that biogas plant, and that will feed into the new plant at Plant 2. And if that's successful, we'll expand it, and that will be running off waste food. I find it unethical with the amount of food that gets wasted, and if we can reuse any of that food, I think it's great. A city like Sydney could waste 3 to 4 million tonnes of food annually. And of course, we've always, over the last 20 years, supported the Children's Cancer Institute very strongly over that period of time. So looking at the divisional review, as you know, the 4 divisions we look at are investments, property, building products Australia, building products North America. Just looking at investments to start with, and I won't say too much about it because I know a lot of you are staying for the Soul's presentation. The contribution almost doubled at $181 million, thanks to the strong support of New Hope Corporation. We received $61 million in dividends, and as I mentioned before, the value of our holding is $2.4 billion. I won't go over that. I'm sure the Todd will talk about that later, but a very impressive result. 12.2% over 20 years, but even more over the 40-year, the longer term. I won't go into too much of this. I might jump over that because I know Todd's going to talk about it soon, but I'll talk about the Milton transaction. I'll move to property. As we said, there's the Industrial Trust, which is a joint venture with Goodman, where we own 50% share. For the Manufacturing Trust, we own 50.1%. Certain advantages in doing that. But outside that, we retain over 5,000 hectares of land. Looking at the property result, unbelievable effort, $644 million EBIT, up 155% on last year. The trust income was up 17% to $36 million. Interesting in that profit, if you have a look at it, the revaluation was $227 million, which was surpassed by the development profit at $387 million. So I think it's important that the development profit actually exceeded the revaluation profit. The revaluation profit came from a 50 basis points reduction, but also there was $42 million associated with fully serviced land, which is available for development. The development profit resulted from the completion, of course, the main one in the first half, of course, was Amazon, but there were properties also at Rochedale, Oakdale South and Oakdale West. And also because some of those properties, they were delayed because of the rain, and they may have normally would have finished last year, but they were 80% complete. They've been brought into the profit into this year to meet our requirements and the accounting standards. I won't talk about that. Just looking at the trust, the total trust now has assets over $3.3 billion, and if you can see that line there on the right, if you add the industrial trust on top of that, you get to that $1.75 billion. But it took us, it's amazing with these things, it took us, a dozen years to get to $900 million, and we almost doubled it the following year, so incredible. So inside the trust, there's $867 million worth of land that is currently under development, and there's land including the development land in the trust. So there's properties under development land in there to a total value of $867 million. And I just want to go to Grant. What did we decide this morning? Was it how many square metres were we had? 158,000 metres, was it? 158,000 square metres of future developable area as well. So if you look at that, if you break down the total value less the debt, we come up with $1.543 billion for the industrial trust. And the gearing, very importantly, the gearing in the trust is only 26%, and generally we have a headroom of 55%, so it's very lowly geared in there as well. Looking at the overview of the properties, I guess there's 15 years work there building this scale of this out. The current annualised gross rent is $127 million. The WALE is 7.3 years. The cap rate's 3.6%. The gross level area, just shy of 1,918,000 square metres. So it's a significant series of estates. The Oakdale South Estate and Rochedale are now complete for the time being. And if you look at that from a photographic point of view, you get some idea of the scale. I mean, if you look at Amazon there in the foreground, in the 2,000 car spots, it sort of sets the tone. But that's a 10-storey high building. And Coles is bigger behind it, and Ozpost, Xylem and Telstra, all in Oakdale West. Oakdale South, as we said, just about finished. Oakdale Central finished. And Oakdale East is really sort of points to where we're going to go in the future. The only number I didn't mention, there was 144,000 metres of pre-commitments currently under construction. Okay, so looking at the manufacturing trust, and the reason we did this, we felt that we weren't getting the value inside the building products, that people value it on earnings, but they forget that what the assets that are sitting in there, so we try to bring that out and realise that. But also we think the number of the properties that we can work with Goodman to, if you like, concentrate the footprint of the manufacturing and make more land available for further development. So there's 15 properties, total of 496 hectares. The value is $416 million, 50.1% interest, as I mentioned. So there's no debt in there, no debt, and so our value is $211 million after stamp duty. I mentioned that. And the leases, we sort of set the leases depending on what we thought the lifetime of the facility was, and so they range between 5 and 20 years, and a number of them with multiple options. Looking at future properties that we have coming through, there's 4 main parcels of land I wish to bring to your attention. When I say we have 5,300 hectares of available land, I mean, a lot of that is maybe in regional areas or quarries that would never go into it, but these 4 parcels we've identified as having a potential. And we've valued them as is, where is at 0.8 billion. When they're rezoned, they'll be worth somewhat more than that. So on the top left, Oakdale East, which is, you've got a little blue corner there, which is the first stage of Oakdale East we did. There is 75 hectares there. Plant 3 sits on that parcel, and there's a quarry behind it. We're obviously building Plant 2 to replace this plant. When that happens, it's been delayed, of course, with the delay of Plant 2. We'll be looking at turning Plant 3 off, demolishing it, rehabilitating and putting it in, and therefore at that point the raw land will be worth about $300 million, and fully develop that site, the rest of that site will be worth $1 billion. On the right-hand side, we have Craigieburn. We've been talking about Craigieburn a long time. One year we'll get there. 332 hectares, so that's a massive parcel of land. I think there's about 180 hectares net developable in there. Looking at the Horsley Park site, where we have Plant 1 and 2, there is surplus land there as well that could possibly be developed. There's a few planning issues we're working on that one, but that's another potential site. That's 83 hectares. And then in North America, initially I know, I said to a lot of you that we didn't think that there was much potential with the value of land. Unfortunately, or fortunately, we were wrong. 600 acres at Mid-Atlantic. Most of it is already zoned industrial. We have our Mid-Atlantic plant, which is the closest brickworks to New York. It makes about 100 million bricks and is running at full capacity. But there's parcels of that. There's a first stage we're looking at developing, and we've signed a heads of agreement with Goodman to investigate that going forward. Okay, so now turning to building products. Market activity in Australia. Well, it's been interesting, you know, the home builder incentive that the government put out there during the middle of COVID was far more successful than they thought it would be. And at the same time, we got hit with lots of supply bottlenecks, and it's been quite a difficult period, I'd say, for a number of builders. And there'll be many builders out there that'll be building homes today relating to that program, which they'd be building them at a loss. But anyhow, I won't go in all the ins and outs of all the difficulties. I think you've seen enough of that in the press. But our feeling is that we've come back down now to pre-COVID levels. Normally you'd expect it would stabilise there, but it really depends on how aggressively and how much further the government lifts its interest rates. Okay, looking at the actual earnings there, sales are up 7% to $694 million. The headline earnings include $89 million coming from the sale of the manufacturing trust. Without that, the EBIT was up 34% at $64 million, and the EBITDA was $116 million, up 19%. As I mentioned, it was a bit frustrating. I felt we could have done more, but you know, how much more who knows. It was what it was. Looking at the various business performance, Austral Bricks was a standout business. Particularly on the East Coast. We saw the cost increases coming about 18 months ago. We decided that we were not going to get caught behind the cost curve, and we aggressively pushed our prices, generally in the order of 8 to 10% on the East Coast. And then we instigated a second price rise halfway through the year when we saw the scale of what was going on. So we got in front of the curve, but on top of that, we were lucky that we had long-term gas contracts, electricity contracts, that roll over at the end of this year for another 2, and we're protected from that through to the end of now 2024. So our gas and electricity are tied in for another couple of years. So we've got a bit of time there to manoeuvre and just see what goes on. But that was one of the main things. The construction of our new plants that we're building, the masonry plant, we got operational during the year, at least the block side of it. The value add is still in commissioning. It was heavily delayed because we couldn't bring in the technicians from Europe until recently. Our brickworks, well, I'm glad we started when we did, because I'd hate to be trying to convince the board to build it today, because it is running about a year late and extremely over budget. It did get flooded no less than 3 times in the first half of this year, and we've been waiting on, and still are waiting on, certain supplies, SEW drives, dump valves, all sorts of things, bits and pieces. And maybe the worst, if you're talking about interested in the supply chain, the worst part of the supply chain is the parts you need to build factories. That's the worst part of it, because if you've got an existing factory that makes cars or makes bricks or whatever, they're up and running and they're all complete. But where you need the parts to build a factory, that's the bit that's really is of concern. Looking at the American operation, it was great to be able to deliver some earnings for once. But looking at the overall market was up 10%. Housing starts actually peaked at 1.7 million units, which was the highest since the GFC. It was a phenomenal number. I think, you know, and I've been asked many times what the split of our business is, and you see it there. And I think where people get that a little bit wrong, they look at detached housing and multi-res as the same, and they're not. They're really quite different markets. So we tend to look at it as detached housing. We've got about 45%, and it's up from where it was. Whereas we look at non-res and multi-res, as being in the same market segment for us, and that's about 55%. So, whatever, you know, detached housing and tract housing, particularly in Texas, increased strongly, and we got a lot of that business during the year. What we have started to see is our traditional business, our main business, the non-res market, come back, and that was really knocked around during COVID. We lost that, and that's what, you know, kept the lid on our prices. But we're now seeing that come back. And also during this period, we bought IBC 1st of August last year, and they were very strong in the Midwest, Indiana, Illinois, Iowa, Ohio, Minnesota, and Michigan. That area now accounts for 60% of our business, and our largest business is, of course, New York, where we've got close to 60% market share. And the business we do in New York, when I talk multi-res, I'm talking about 50-storey or 70-storey residential towers. You know, along with universities and schools and hospitals and police stations, etc., fast food chains. So looking at the results, revenue almost doubled. I don't know why we didn't get the extra $1 million and make it 400 million, but 399. I mentioned the acquisition of IBC. EBIT was 25 million. EBITDA was 48 million. We had one sale of one of our quarries from York for 13 million, or it was a couple of quarries there making up for 13 million. So it was well up on the prior year, 113%. The EBITDA was up to 35 million, and EBIT increased to 12 million without the land sales. So it was a good performance, and that was really all done in the second half. If you remember back to the first half, we were really at break even. And I think what you're going to see also coming forward is generally there'll be some land sales and things, because there's lots of parts. As we've consolidated, we've released a lot of land. Right. I think I'd say there, many of the sort of situations you're seeing in Australia as far as supply chain is the same over there. You know, you can't get trucks, you can't get rail cars, you can't get people. You know, those sorts of things have been very difficult. But we did achieve a lot over there during the year. We've expanded our distribution network dramatically with the acquisition of IBC. We rationalised our plants from 16 to 9. So the 7 plants we took off, most of them should have been closed maybe 20 years ago. To the plants, the fleet of plants we've got running now are all generally post-2000 construction. We did get a long way behind in our engineering objectives because of the pandemic, and our engineering team couldn't travel. And we're now focused on that, on getting these plants to the efficiency and the performance that we want, now that we're able to sort of run most of them all year, most of them at full speed. The board's approved the recommissioning of the second kiln at Adel, and we're investigating recommissioning of 2 other plants that we have in the fleet, modern plants that are currently offline, and bring them online. And we think there's very good potential to take their output. We launched a lot of products. We completed some capital works at Handleaves, completed, and at Lawrenceville. We opened which is shown there in the slide, our new design studio at 5th Avenue, York, which has really set the stage, set the standard for us in the United States. So I'll now hand over to Grant, who will do the financials.
Thanks, Lindsay. As Lindsay mentioned, total underlying group EBITDA for the year was 1.058 billion, up 133%. After depreciation and amortization, the underlying group EBIT was up 154% to $982 million. Total net borrowings were $20 million, and underlying tax was $216 million. This resulted in a underlying net profit after tax from continuing operations of $746 million, up 159%. Significant items increased net profit after tax by $124 million, resulting in net profit after tax from continuing operations increasing 258% to $870 million for the year. As Lindsay mentioned, Austral Precast is now classified as discontinued operation. The business contributed an after-tax loss of $15 million, made up primarily of the impairment of the non-cash impairment to the carrying value of the plant and equipment in that business. Including this loss, statutory net profit after tax was $854 million, up 257%. The table on the screen shows the significant items in more detail. Key items include a net profit of $271 million following Soul's merger with Milton, included a $452 million profit on the deemed disposal of our Soul shares, partially offset by a Brickworks share of a goodwill impairment incurred by Souls. A $40 million post-tax gain from other Soul significant items, mainly related to the deconsolidation of New Hope Corporation. A $17 million expense in relation to the deferred taxes on the movement in our Souls holding. A non-cash impairment in Building Products Australia. This was based on management's assessment of more conservative forecasts of building activity over the medium term in light of the increasing inflation and interest rates and pressure on global supply chains as compared against 31 July 2021. These factors, together with the increased lease asset base and a higher discount rate, have resulted in the recognition of a non-cash impairment of $117 million post-tax. A net $28 million cost is associated with the plant relocation and commissioning costs. This is primarily attributable to the non-cash impairment of buildings, plant and equipment, and clay in relation to the planned closure at Plant 3 at Horsley Park. He also incurred after-tax restructuring costs of $10 million, largely related to the planned shutdown of the Bellevue plant in Western Australia and the closure of our Caledonia plant in North America. COVID-19 related costs were incurred of $8 million, reflecting the unabsorbed fixed costs in our North American plants and incremental costs such as the construction delays on our major construction projects and the cost of our rat testing program across the operations. Turning to the cash flow, total operating cash inflow for the year was $130 million, down from the $140 million in the prior year. Cash generation was impacted by increased inventory in Building Products operations and higher payments, including interest payments on leases. Capital expenditure was $134 million during the year, including the purchase of 121 hectares of land at Bringelly to support our future brick-making operations. And the company is midway through a significant investment program across a range of major projects. Project spend included the new brick plant and masonry plants in Sydney that Lindsay already touched on, and extensive upgrades at our Hanley plant in Pennsylvania and our Lawrenceville plant in Virginia. We also finalised the deployment of our new ERP system in Australia. In addition, we spent $75 million on acquisitions, primarily the IBC purchase in August of 2021. Offsetting that, we had gross cash proceeds of $277 million received in July in relation to the sale of the properties into the Brickworks Manufacturing Trust. Looking at some of the key financial indicators, net tangible assets per share up 33% for the year, over the year to $18.34. Uplift is primarily driven by the increase in the industrial and manufacturing trust values. Shareholders' equity increased by $780 million to $3.26 billion, representing $21.48 a share. And underlying return on shareholders' equity was 23%, up 12% on the prior year. We touched on operating cash flow earlier at $130 million for the period. Net debt decreased by $25 million to $493 million, and together with the significant increase in equity, as Lindsay mentioned, that decreased our gearing to 15%. Interest cover increased to 35 times. Looking at our debt maturity profile, during the year we refinanced 2 tranches of our existing syndicated debt facility and added 2 additional US dollar tranches. This increased our committed debt facilities from about $830 million to around $1 billion. It includes a syndicated multi-currency facility of around $742 million, bilateral cash advance facility of $75 million, and an institutional term loan facility of $186 million. We have around $510 million in funding headroom based on our committed debt facilities and cash on hand, and we, as you can see on the screen, significant headroom in our banking covenants. During the year, we also renewed a lease over part of our brick plant at Wollert in Victoria for a further 5 years commencing May 2022. I'll hand back to Lindsay for the outlook.
Thanks, Grant. Sorry, just got to find the right page. Okay. Moving ahead to the outlook. Following the recent Soul's merger with Milton, the larger Washington H. Soul Pattinson, I think, will deliver superior long-term returns, consistent dividend growth well into the future. I've discussed the strong development pipeline with the Industrial Property Trust, and particularly we're looking that Oakdale West will continue to drive this area. The Brickworks Manufacturing Trust, I think, opens the opportunity for us to do further development on those sites. And as I've mentioned, we're exploring the opportunities in North America with heads of agreement signed, a non-binding heads of agreement signed with Goodman. I think in Australia, I think it's maybe one of the major concerns that people have with the future here, but there is a significant pipeline of work that I feel has got most probably 9 months or 9 to 12 months to run in this first half and into the second half. They're still working off a lot of that stimulus homes that were agreed to or committed to 18 months ago, and that's just going to take time. And at the moment, there's still, sorry, thanks, Mark. Still, the construction is very inefficient because it's not happening in not the normal sequence of events because of the shortage of materials and shortage of trades. And if it slows up a little bit, what I expect we'll see was a more efficient construction process, and therefore it might help things continue moving. In North America, the conditions are very much as they are in Australia. Short term, we see a strong backlog of work, and particularly in some of those areas where the new areas we're supplying, as in Texas, there's an enormous backlog of work there, and it's just going to take a while to work its way through. In terms of the impact of the Manufacturing Trust on group NPAT and cash flow, we expect that there'll be no significant impact because of that. Although we will be subject to further revaluation or devaluation profits in there, the same as we would be on the Industrial Trust. I guess we've all seen that the future is a bit uncertain as far as interest rates, etc. We're hoping that we're going to start seeing some of the international supply and that loosen up a little bit, but of course a lot of factory facilities have gone offline in Europe with the shortage of gas. And we're just watching that just to see how that sort of pans out, but it is a bit of a concern at the moment. And that's it. So if we've got any questions, happy to take them. Do you want to start here or do you want to start online? Or have you got some online there? Okay, we'll do the online ones first.
Okay, the first question is from Eric Johnson. How would you describe the trend of current inflation pressure in your business? Accelerating, slowing, and what are the biggest drivers?
Look, it varies a little bit from area to area. I mean, international shipping is a really good one to watch because it impacts so many things. We were paying about $9,000 US a day for a 25,000 tonne bulk carrier pre-COVID. That went to over $40,000 a day. It came down a bit before the Ukraine war, but went back to 40,000. But now that's dropped to about 16 to 18,000 a day. That seems to be coming off. So that side of it, seems to be clearing a little bit. If you've been watching the photos of the ships moored off Los Angeles, you'll see that there's none. They've all gone. So the bottlenecks are clearing. But other things are still, there's a shortage. You can't get, or you can get trucks, but they're expensive. The chairman mentioned pallets. Containers are hard to get. Rail cars are hard to get. We're not out of the woods yet. It's difficult in these areas. So I think there's some of them that'll be softening, but other areas I'm not quite sure where they're going to go. Like things like natural gas, even though we've got a good position about it. I mean, I don't think in the broader market, unless we get some more gas fields on, this is obviously going to remain tight for some time.
Okay, next question is from David Williamson. Given Soul has declared a special dividend, is it likely that Brickworks will in due course follow suit?
Well, I didn't know. Look, I think one of the things is we did do special dividends 20 years ago, and I don't think we really achieved much for our shareholders as far as our value is concerned. And so we've tried to, on the other hand, just regularly keep increasing it is our main goal, if we can achieve that, so people can rely on the dividend. Because a lot of, we've got 25,000 shareholders now, a lot of those would be retirees or pensioners, and they want to see the dividend check. So, I think consistency is maybe more important than just outright scale.
Next question. Lindsay, do you think the Goodman JV business could be as successful in the US?
Well, we've identified one property. I think let's work our way through there. We haven't done anything with them yet, so we've obviously got to learn the ropes over there. It is slightly different. Although I must admit, we're finding that the politicians from both the House of Reps and the Senate for these various states are very, very supportive and really go out of their way to try and help you invest in their areas. So that side of things is very positive. But a lot of our land, of course, is in rural or regional areas and doesn't have the value. But the Mid-Atlantic side is a good opportunity.
Next question. Are you able to pass on inflationary costs in the building products division? And are there inflation-linked rent increases in the property trust?
The answer to the first one is yes, and I think I covered that. The second one, the leases are either inflation-based or they're fixed term, but there's only a couple of them leases that are very long-term. Most of them sort of roll over in a certain period of time, and obviously when they roll over, they'll go to inflation-based leases. But the other thing that will happen when they roll over is, of course, we're getting much higher rental rates. To give you some idea, some of the properties, the smaller properties, we might have been doing at $120 to $130. We're now seeing sort of $170 to $180 a square metre for rents. So there's been good uplift in the rental rates. There is no vacancy, so I think we're able to recover those increases and able to get leases under those arrangements because of the tight market.
Question from Robert Rex. Why was the dividend increase so small in relation to profit increases?
Well, I think the main thing is we've just got to keep an eye on what's going to happen next year. I mean, there's a lot of things a lot of moving parts that nobody knows the answer to, and we've just got to be conservative until we find out, how this year pans out.
Well, that's it for online. Thanks, Lindsay.
Okay, all right. Questions from the floor? Raju. Welcome, Raju. It's great to see you.
Thanks, Lindsay. Raju Ahmed from CCZ. Couple of questions. Going back to the property business, just focusing on two things. You've changed your development profit accounting from 100% to 80% completion. Does that impact FY23 development profit?
Well, a lot of that was brought forward, so generally, rough rule, don't hold me to this, rough rule, 80% of the profit was brought back into last year. There would have been in this year. But there would have been in last year if they weren't delayed. So, I mean, it depends how you look at it. If we hadn't have had all that bad weather, most of those properties would have mostly PC'd at the end of last financial year. And because of the delay, they're pushed over into the next year, so, yeah.
So do you expect the profit levels to be as chunky as it was this year?
Well, just to say it was a very good year. I can't forecast what's going to happen next year.
Okay, all right. And looking at your Mid-Atlantic site, can you give us some color on what dimensions, what's the size of that place? What are you thinking?
600 acres. I think the first area we look at, Megan, what's 180 acres, that first stage we're looking at? 180 acres. Might have a market value over 100 million US.
Okay, all right, very well. Coming into Building Products Australia, okay, I understand volumes might ease up from the second half of FY23 financial year. I am aware that you've got a wholesale supply agreement with Santos for natural gas. If the volumes were to ease, do you think on selling that gas into the retail market could actually buffer the EBIT decline?
Look, we have a lot of flexibility in our gas contract, so we won't be caught with gas that we don't need. I think it's the first thing, and we have got flexibility if for any reason we're not producing, that we can move that gas back into the wholesale market. But look, that's just a bit of a move. You plan that, okay, it would make sense to close in winter and sell the surplus gas, but we've had a shutdown at the moment. One of the plants has needed some repairs, and so it's gone off now. So you can't always pick it as to when you're actually going to close things down. So,
Okay. And just staying on in Building Products Australia, I think you mentioned through your presentation that all else being equal, you expect volumes to ease towards the pre-pandemic levels. Now, if my memory serves me right, pre-pandemic was you just came out of the impact of the Banking Royal Commission, which had a downward impact on housing starts for a period of time. If you've got multiple waves of hit, like the pull forward of demand because of the home stimulus in the pandemic, and then now you've got rising interest rates.
yeah, I think to counter that though, Raju, is the fact that you've got rental vacancy rates is non-existent. There's no and believe it or not, obviously more people have come into the country this year. The students have come back, the people on short-term visas have come back. The government's talking almost 200,000 immigrants a year, and we're already full. So on one side you've got interest rates trying to slow things up, but on the other side you've got demand. It's just going to be interesting to see how they pan out.
So at this point, your expectation, it's more of a shallow dip for a period of time rather
Well,
than a structural decline?
I don't know how to answer the question. I mean, interest rates, what's the US Federal Reserve going to do later today? I mean, it's nobody knows at this point in time how high interest rates are going to go, but I assume they're going to keep increasing interest rates so they get rid of inflation.
Okay, and the very last one, Building Products North America. I think originally when you sort of synthesized the strategy, it was about the strength of the commercial opportunity. Are you seeing telltale signs of that opportunity now emerging?
Well, yes. I think those larger jobs really got knocked around with COVID more than anywhere else. And that architectural billing index is a very good indicator of how busy all the architects are, and they're all absolutely flat out. So there's a lot of work coming through, and I'm hoping that a lot of that work is going to be less interest rate sensitive than the housing work. But definitely from a point of view as for the selling prices we achieve, they're more than double what you get from housing. So it's a much more profitable business. And that's why you look at, when I said before that our, in sales dollars, we're the equal second biggest brick maker in the US. Now, the other one makes most probably 2 or 3 times our volume, but they sell their bricks for so little they don't actually generate much income. You understand what I'm saying? So,
Okay, thank you very much.
thanks, Roger. Any more questions? Oh, okay. Okay.
Hi, James Arsides from Jarden. Just wanted to kick off on the Aussie business in light of the impairment that was put through. Just wondering if you're seeing any kind of pockets of concern directly with your own customers, or is it more of a macro concern at this point about how things will play out?
Impairment's one of my favourite subjects. I've got to have my auditor here. Careful what I say. Look, I think we took the view that the future was wasn't so certain, and we backed down our forward estimates. So that obviously impacted. Also, the higher interest rates have impacted on it. But some of the things. The biggest piece, of course, was the impairment of the goodwill in the brick business. Now that goes back to 2003 when we bought Bristol. At the time, this was all amortised. We wouldn't have had any goodwill left by now if that had been amortised, but the change in policies meant that it was still sitting there. And so eventually it was going to get caught, Eventually there's going to be a downturn and there'll be impairment, so that's just the way it is.
And then more of a housekeeping question, just on the second price rise that you put through, you said 8 to 10 was the first. Have you quantified what the second price rise?
I think I was saying that we've got 8 to 10 overall. So
Overall.
Some of the states are a little bit lighter. Some of the states went, 8% sort of straight up, but others that maybe only went 5 or 6, went back in for 4 or 5.
Okay, great. And then it'd just be great to get a comment on your interest in FBR. Obviously, that's been increasing over the past little while. Just, want to get your thoughts on how you see that business evolving and what your relationship might look like in the future.
Oh, well, yeah. Look, they've made a lot of progress, I think, in the last few years, and I think it's an area that we want to be part of. So, there was an opportunity. And most people don't realise, but we're one of the founding investors, and we've always held a shareholding in them. So.
Okay, great. That's all from me.
Any more questions? Very good. Thank you. Well, I'll be here for a while, and Grant will be, and the chairman. So if you want
Sorry,
to.
Lindsay, I've just got a couple more online.
Oh, okay. Okay.
How do you see medium-term demand for industrial space and rents, given the poor updates from FedEx in the US?
Well, yeah, but at the moment, there's virtually no space available. There's no doubt there could be a bit of a slowdown as people reevaluate it. And it's not only, I think, reevaluating what they need as far as warehouse space in regards to what their demand is. It's going to be reevaluated because the cost of construction has lifted so much that some of these, the amount of rent they've got to pay to get that, people might find that stretches their operating model a little bit. So I wouldn't be surprised if there's a bit of a slowdown for that reason. Or the other issue we're seeing, I think, is going to emerge is that and I said the real pinch point is in building factories. Well, if you're distributing food and you've got to put an automated warehouse in, you've got to go get that automation for the warehouse, and you might not be able to get it. And that, I think, is going to put a bit of a dampener on it. But at this point in time, we're 100% leased. We've got lots of demand, particularly in some of the small parcels. We're seeing good rent increases. So at the moment, it's not eventuating.
Right, a question from Daniel Kang from CLSA. Firstly, can you quantify the profit impact of disruptions during FY22? Could we see a profit benefit from the likely non-repeat of these disruptions? And secondly, can you quantify the benefit of plant closures in North America? Any likely further closures?
I'll handle them in reverse. No further closures. The benefit takes about 1 to 2 years to come through because you've got to run off the stock and get rid of the sites and move the products across and get the market used to it. So that takes time. And then you've got to get an opportunity and fix the factory up so you can run it all year and run it at full speed. So that takes time. That's started to come through and will continue to come through over the next 12 to 18 months. The value of, we didn't value the cost of the disturbances. Some of them, which we could, went to the non-regular significant items. I always thought that's a little bit like the dog got my homework because, we might have a wet month this month, but then we catch it up next month and it just moves it around. So I just don't think that was that significant. But we did in the early part of last year have shutdowns in our 2 major markets, and that did knock us around in August and September last year. And we're seeing, we were seeing better performance this year, but then we've had a couple of problems with plants. So if it's not something, it's not one thing, it's something else. And so it's not something I put a lot of credence on.
Another question. Have management considered a possible change in structure of Brickworks in the future, such as a demerger between the property trust and building products business, with a view to the value of these assets being better reflected in the share price?
Yes. But look, we've got a very strong model and it does work. Building products is a volatile business, and the fact that we've got these investments allows us to, perform strongly in difficult periods and allows us to reinvest. And if we didn't have that, we wouldn't be the company we are today. And I think the fact that, Brickworks is mostly, one of the biggest building products companies, investment company in Australia today compared to 25 years ago when we were sort of one of the smallest, I think says a lot for our model. It's worked very well over a long period of time.
No further questions.
Okay. Oh, okay, yeah, we've got, Sol's going to start in a few minutes. So last question. Last question, that's it.
Hi, Suraj Nibhani from Citi Research. Question on the property business. Development profits, they were a strong contributor this year. How should we think about the key development completions over the coming years, I guess, which could contribute to profit?
Yeah, well, I think we highlighted the ones that are yet to be completed, and I think we sort of also highlighted that 80% of the potential, approximately 80% of the potential profit has been taken up. We don't know until we get a valuation on PC, what the final values of them are going to be. But and I don't think really anything we can start now. We're going to get finished this year, Megan. It's just about it's too tight to do it. The construction process in industrial warehouses slowed down too compared to everything else. I mean, there was a time when they'd turn the first side of dirt, and 6 months later they'd move in. I mean, but I think those days for the time being are not there, so it's taking a bit longer to get these buildings up. So
Thank you.
good. All right. So just a reminder that Sols are on at 1 o'clock. We're here if anyone wants to ask any questions. Thank you.